When most people look at the market today, they still think the main story is AI, technology stocks, and whether the next big company will benefit from the digital boom. And yes, that story is still there. But under the surface, another force is slowly becoming much more important. And in my view, this is the force that can decide whether markets stay strong, become volatile, or enter a much tougher phase in the months ahead. That force is oil. Not because oil itself is suddenly exciting, and not because investors want to go back to old commodity narratives, but because when oil starts moving sharply during a period of geopolitical tension, it can quietly change inflation expectations, interest rate expectations, global capital flows, and eventually stock market behavior. And this is the part many retail investors miss. Markets do not usually crash because of the headline everybody is shouting about. They struggle when the headline changes liquidity. So in this video, I want to break this down in a very simple way. We will talk about why geopolitical tension matters for both Nasdaq and Nifty, why oil is the real transmission channel, how this situation compares with past market shocks, what makes this cycle different from before, and most importantly, what investors should actually watch and how to think during such periods. Because in uncertain times, the biggest edge is not prediction. The biggest edge is understanding how the system works. Before we go further, a quick disclaimer. This video is only for educational and informational purposes. These are my personal views and observations as an investor looking at global macro trends. This is not financial advice, not a recommendation to buy or sell any stock, and definitely not a prediction of what the market must do next. Markets involve risk, and you should always do your own research or speak to a qualified financial advisor before making investment decisions. Over the last few years, the market narrative has been very clear. First, after the pandemic, we had a liquidity driven market. Central banks flooded the system with money, interest rates stayed low, and that liquidity pushed up almost everything. It did not matter whether the business was mature, cyclical, speculative, or even overvalued. If liquidity was abundant, markets found a way to go higher. Then the story started to change. Inflation came back, central banks began tightening policies, and suddenly the market became far more selective about where money flows. Investors were no longer chasing everything. They started looking for the next real growth engine. That is when AI stepped in as the new driving force. Capital quickly shifted towards semiconductors, cloud infrastructure, data centers, advanced software platforms, and almost any company that looked positioned to benefit from the next big wave of digital transformation. So, for a long time, many people assumed the market would keep being driven mainly by AI, earnings, and interest rate hopes. But what happens when geopolitics suddenly enters the picture in a meaningful way? That's when things become more complicated. Because geopolitical tension, especially in regions connected to oil supply, does not stay limited to one sector or one headline. It starts affecting real world costs. It starts affecting inflation. It changes how central banks think. It changes how big money moves. And that is why this topic matters. This is not just about one conflict or one weekend news cycle. This is about whether a new macro variable is entering the system at a time when valuations are already elevated and many investors are already positioned for a more comfortable environment. Let's simplify this. If there is tension in a region that handles a large portion of global oil supply, markets immediately begin pricing the possibility of supply disruption. The market does not wait for complete confirmation. It starts reacting early. And once oil moves up sharply, the impact spreads far beyond energy stocks. Oil is not just another commodity. It touches transportation, logistics, aviation, chemicals, manufacturing, shipping, and consumer prices. Even if you never buy oil directly, you feel its effect everywhere. It can raise the cost of moving goods, producing goods, and ultimately living. Now think about what that means for markets. When oil rises quickly, inflation expectations begin to rise with it. Investors then start asking whether central banks can really cut rates as aggressively as the market had hoped. Bond yields react, the dollar reacts, risk appetite reacts. Equity markets suddenly become nervous. This is why I keep saying that markets do not struggle because of war headlines alone. They struggle when those headlines create a macro chain reaction. And the chain reaction usually looks like this: oil rises, inflation risk returns, central banks become more cautious, bond yields stay high or rise, liquidity becomes tighter, growth stocks reprice, emerging markets become vulnerable, volatility increases. That is the actual mechanism. So, if you are an investor and you want to understand whether this kind of geopolitical event really matters, the first thing you should watch is not social media noise. It is oil. Because oil tells you whether the market is taking the situation seriously. Now, some people might say, okay, India is oil dependent, so obviously Nifty reacts. But why should Nasdaq, especially tech heavy Nasdaq, care so much? That's an important question. Nasdaq is full of growth companies, and growth companies are extremely sensitive to liquidity and discount rates. In simple words, when money is cheap and interest rates are expected to fall, high growth stocks look more attractive because investors are willing to pay more today for future earnings. But when rates stay higher for longer, or when inflation risk comes back, those future earnings become less attractive in valuation terms. That is why a lot of the Nasdaq rally has depended not only on earnings but also on the belief that inflation would continue cooling and central banks would eventually ease. If oil pushes inflation back into the conversation, that changes the mood very quickly. Nothing needs to go wrong with a company's business for its stock to fall. If the market suddenly thinks rate cuts may be delayed, valuations can compress even if earnings remain strong. That is especially true in a market where some sectors have already had huge runs. So when I look at Nasdaq in this type of environment, I do not just ask whether AI is still strong. I ask whether liquidity conditions are still supportive enough for the market to keep paying such rich valuations. That is where the real risk comes from. It is not that the AI story disappears overnight. It is that the macro environment becomes less friendly. Now let's come to India, because the transmission channel is different. India imports a very large portion of its crude oil. That means when crude rises sharply, India feels it more directly. It increases the import bill, it can pressure the rupee, it can make inflation more uncomfortable. And once inflation enters the picture, domestic policy flexibility also becomes more limited. This matters because Nifty does not trade only on local company earnings. It also trades on capital flows. When global investors become nervous, they reduce exposure to riskier markets first. This does not mean India is weak. It simply means global capital becomes more selective. That is why, during geopolitical stress, Nifty can face pressure even if domestic growth remains decent. The market starts asking questions like: will higher oil hurt the current account? Will the rupee weaken? Will inflation become sticky? Will RBI become more cautious? Will FIIs reduce risk? And once these questions start dominating, the market becomes much more volatile. This is also why you often see sectors like aviation, oil marketing companies, paints, tires, logistics, and other oil sensitive businesses come under pressure. Their margins become vulnerable. At the same time, some sectors may behave relatively better. Defense stocks often attract attention during conflict-driven narratives. Pharma can act defensive. Select IT can sometimes hold up better if the broader market is weak, although that also depends on the global environment. So in India, oil is not just a commodity issue, it is a macro issue, a currency issue, an inflation issue, and a market liquidity issue. This is where perspective becomes very important. We have seen versions of this before. During the Gulf War in 1990, markets reacted sharply because of oil shock fears. The initial phase was full of uncertainty and selling pressure. But once the situation became clearer and oil stabilized, markets eventually found their footing. During the Iraq War in 2003, markets were volatile heading into the conflict. But once uncertainty reduced and the worst case fears did not materialize in the same way, equities recovered strongly. In 2022, during the Russia-Ukraine conflict, we saw something even more relevant for today. The market did not just react to war. It reacted to the inflation shock that followed through energy prices. That inflation shock then forced central banks to become much more aggressive, and that had a major impact on global equities, especially rate-sensitive growth sectors. So the lesson from history is very clear. Markets usually do not collapse simply because conflict exists. They become unstable when conflict changes inflation, policy, and liquidity. That is the framework serious investors should keep in mind. The market always asks the same question in different ways. Is this event changing the future path of money? If the answer is yes, then markets care deeply. This is where perspective becomes very important. We have seen versions of this before. During the Gulf War in 1990, markets reacted sharply because of oil shock fears. The initial phase was full of uncertainty and selling pressure. But once the situation became clearer and oil stabilized, markets eventually found their footing. During the Iraq War in 2003, markets were volatile heading into the conflict. But once uncertainty reduced and the worst case fears did not materialize in the same way, equities recovered strongly. In 2022, during the Russia-Ukraine conflict, we saw something even more relevant for today. The market did not just react to war, it reacted to the inflation shock that followed through energy prices. That inflation shock then forced central banks to become much more aggressive, and that had a major impact on global equities, especially rate-sensitive growth sectors. So the lesson from history is very clear. Markets usually do not collapse simply because conflict exists. They become unstable when conflict changes inflation, policy, and liquidity. That is the framework serious investors should keep in mind. The market always asks the same question in different ways. Is this event changing the future path of money? If the answer is yes, then markets care deeply. Now, why does this situation feel more sensitive than some earlier geopolitical scares? Because markets are already coming into this phase with stretched expectations. We have already had a strong AI-driven rally. Some parts of the market are priced for very strong future growth. Investors have been leaning toward the idea that inflation is under control, that rate cuts are coming eventually, and that the next phase will remain supportive for risk assets. When positioning becomes that comfortable, any new macro shock has a stronger effect. That is what makes this different. This is not happening in a market that is cheap, fearful, and defensive. This is happening in a market that has already priced a lot of optimism. So even if the actual event does not spiral into a full crisis, the repricing can still be meaningful because so much good news was already assumed. That is why I do not think investors should treat this casually. I am not saying a crash is guaranteed. I am saying the market is in a zone where downside reactions can become much sharper if the wrong macro variables stay elevated for too long. When uncertainty rises, many people make the mistake of watching only the index. But serious investors watch a few deeper variables. The first is crude oil. This is still the most important signal right now. If oil spikes and stays high, markets remain under pressure. If oil calms down, the market can stabilize surprisingly fast. The second is the US dollar. In periods of risk aversion, the dollar often strengthens. A stronger dollar usually creates pressure on emerging markets and commodities. The third is bond yields. If yields keep moving higher, it tells you the market is worrying about inflation and tighter financial conditions. The fourth is foreign capital flow. If FIIs begin selling aggressively in India while crude remains high, that is a sign that risk appetite is weakening. The fifth is credit spreads. This is something most retail investors ignore, but it matters a lot. If credit spreads widen, it means financial stress is increasing beneath the surface. These are the signals that tell you whether this is just temporary fear or the beginning of a more serious volatility regime. Now let's come to the most practical part. What should an investor actually do in an environment like this? First, I think this is not the time for emotional decision making. Extreme volatility creates extreme headlines, and extreme headlines push people into bad decisions. Second, I think investors should become more selective. In easy liquidity markets, almost everything can go up. In macro sensitive markets, quality, earnings visibility, balance sheet strength, and structural demand themes matter much more. Third, I think it is important to separate short term volatility from long term structural trends. Just because the market becomes volatile does not mean the AI story disappears. It means AI now has to coexist with macro reality. Fourth, I would say watch the sectors that are naturally stronger in this type of environment. Energy, defense, some healthcare names, power and infrastructure stories, and companies with pricing power may behave differently from crowded momentum trades. And finally, keep some flexibility. In uncertain periods, cash is not laziness, it is optionality. It allows investors to react calmly instead of getting trapped. To be very clear, this is not about trying to guess the exact next candle or the exact bottom. It is about staying mentally prepared for a market that may become much more headline driven than investors were used to just a few weeks ago. So, if you ask me personally how I am reading the current setup, my answer would be this. I do not think this is automatically the start of a market crash. But I do think this is the kind of setup that can turn a comfortable rally into a correction, or at least into a much more difficult and volatile phase. The market has moved from optimism to uncertainty very quickly. That alone changes behavior. In this kind of environment, I care less about daily opinions and more about whether oil stays elevated, whether yields keep rising, and whether global capital starts moving more aggressively into safety. If those things continue, then the market story becomes harder. If those things cool down, then this may simply become another sharp macro scare that eventually creates opportunity. So for me, the job right now is not to panic and not to act like nothing matters. The job is to observe carefully, stay selective, and understand that when liquidity changes, leadership can change very fast. If you stayed with me until here, I hope this video helped simplify what is really happening in the market right now and why oil, geopolitics, and liquidity are so deeply connected. A lot of people think investing is mainly about reacting quickly, but in my experience, the best investors are usually the ones who understand how the system works before the crowd does. If you found this video useful, do support the channel by liking the video and subscribing. That really helps the channel grow and helps me continue putting out more market content in this style. And I would genuinely like to hear your opinion in the comments. Do you think this geopolitical risk will fade quickly and markets will recover? Or do you think oil and inflation could become a bigger market problem in the coming weeks? Let me know your view. Thanks for watching, and I'll see you in the next one.